was a great year for him and his clients. So it's only natural to have him back on to see what he sees for the coming year. And to that point, we pretty much dragged all of our baggage from 2022 over the finish line into 2023. So nothing's really changed or been solved. So let's bring on our next guest so he can hopefully let us know where he sees some of those potholes, where they are in 2023. Please welcome to the show co-founder of Key Advisors Group, Eddie Ghabour. Eddie, great year for you last year. I wish I was one of your customers, one of your clients. But
Thank you.
2022, you nailed it. I think I saw in your notes that you said that was probably one of the easier calls you've ever seen in your entire life. Tell me why that was the case, and then tell me what you think about 23.
So look, the reason why I say that it was a pretty easy call, at least from our perspective, even though it was non-consensus at the time, when we were coming into 2022, no one could argue with the fact of how high asset prices had gone up. And we know the big reason for that was because of the stimulus that the Fed had done and them not tightening rates. And then as we looked at the setup going into the year, we said, okay, we have prices at highs we haven't seen in an extremely long time. And they're getting ready to reverse course on what caused those asset prices to go up. So if you see that, or you feel like you're at peak growth and you were going to decelerate growth-wise, and then you had a Federal Reserve that was going to try to tighten monetary policy and unwind the largest balance sheet in history, to us, it was kind of like common sense that, hey, we want to get out of the way of this thing. And then as the year continued to go on, there were a few places to hide, and that's when we made the decision to just, hey, we need to just start going to cash because we want to be able to buy when we've hit capitulation. Because a lot of people, if you look at some of the most successful investors around the world, recessions and market crashes are when they're able to make money because they have cash to be able to buy. And that's the position we're in heading into this year.
Yeah, that's when things really come on sale. You're right. You want to be able to take advantage of them. So, like I said, we brought a lot of baggage with us over the finish line of 22 into 23. Not a lot's changed. There are some folks we've had on saying that they like the back half of this year better than than the front half. We'll see. But what are your predictions for in the market going forward then?
So I do think we're going to hit new lows, and I think it's going to happen in fairly quick order because there's a couple of things that really have us concerned. Everyone is so focused on whether the Fed's going to cut rates or not, okay? That shouldn't even be on the radar screen. They're not going to cut rates, in my opinion. And if they do, it's because we're in a really bad spot because that's the only time they come in to stimulate. Look at the cost of capital when you compare it to a year ago. There is a tremendous amount of corporate debt that has to get refinanced this year and next year. And there's a lot of these companies that their stock prices have plummeted. So the cost of capital could double or triple for these firms, which means one of two things. Their stock price has to get reevaluated much lower, or they're going to go out of business. And the unfortunate reality is there's going to be bankruptcies when you go into a recession and a bubble burst like this. We've already seen a company yesterday announce that they're potentially going to be doing that. So the cost of capital is a real problem for corporations. And I don't think this market has priced in a recession. And I think that there's still a lot of people that think the Fed's going to navigate a soft landing. When you look at the consumer, when you look at corporate debt problems, and now you add housing on top of that, housing's the one asset that really didn't tank last year. And look at it now. It is slowing down at one of the fastest paces that I've seen in 20 plus years. So nothing touches the economy, in my opinion, more than housing. So if housing falls apart, there goes the soft landing on top of corporate debt. I just don't see how we don't see new lows in quick fashion.
Wow. I mean, that's good to hear. I'll throw this at you. This is what I feel like, too. So been in the business for 37 years. I've never seen in the last 13, 14 years, the Fed The Fed's always been there to rescue people, right? The Fed has distorted asset prices for so long now. It's almost like everybody's accepted that's the new value, and it's not. And so if the Fed's really going to try to get out of the way and take their hands out of the kitty, boy, there's some, like you said, I like that word, repricing has got to happen because they've been there for so long. I mean, you could be a money manager in your business for 12 years and not ever know a world without the Fed being behind you. What do you think? We have 1 minute.
That's exactly right. They're not here to save this market, and this is why, and they shouldn't. We need to have normal interest rates. These interest rates that we think are high are normal. That's what we need to do. We need to get into an environment where investors are paid to have cash and save money. and we're starting to grow slowly without the help of governments pumping money into the system. And unfortunately, it's going to be very painful to get there, but for the long-term prosperity of this country, that's exactly what we need.
That's great advice, and everybody should heed what you have to say, because, I mean, last year we did very, very well, and it sounds like you're going to continue with that course this year. You're calling for new lows in the market, so that'll be interesting to see. I mean, it's hard for me to get, to argue with you, because it's hard to find a lot of really good news out there. And when you've got all those big corporations laying people off, or Bed Bath & Beyond going under, or the president of FedEx saying it's not too hot out there, you kind of have to heed those words. And we're going to heed yours, too, because you did so well last year. Really appreciate you coming on. Eddie Ghabour, he's coming to us from Delaware. Thanks for being on the show, Eddie. Awesome stuff. All right, time now to dial